Well, in its annual economic forecast on Kenya, British American Asset Managers has projected an economic growth of 5.3% for the Kenyan economy in 2012, an improvement from last year's economic growth projection of 4.6%. And joining us now from our studios in Nairobi is the company's CEO, Edwin Dande. Thanks so much, Edwin, for joining us this afternoon. Let's get straight into it, because that revision upwards coming through in terms of economic outlook and growth prospects for the Kenyan economy for this year. What's been the basis for that revision upwards?
Well, hi, good afternoon. We've basically looked at pretty much all sectors of the economy, and the growth is pretty much broad-based. We characterize 2012 as a transition year. If you look at 2011, whether it was in terms of interest rates, whether it was in terms of inflation, or whether it was in terms of depreciation of the Kenyan shilling, and compare that to 2012, we expect interest rates to come down. We expect the inflation to decrease. The shilling seems to be stabilizing, and even in the political scene, we expect transition. So when you look at all these key factors, the 3 or 4 key factors I've talked about, they seem to be getting better in 2012 compared to 2011. And when you take that and run it through pretty much all the sectors, we expect at least growth above 5% compared to what we expect of 2011, which is something around 4.7. So growth from 4.7 to about 5.3% for 2012.
It's interesting that you say that you see interest rates coming down, because if you're looking at those other factors that you've highlighted, inflation coming lower and a shilling that's stabilizing, it's largely been attributed to the fact that interest rates have been on a rise, and we've had the CBK implement tighter monetary policy. So what's your outlook on that monetary policy front?
If you look at the last CBK meeting, they actually held the CBK benchmark rate constant. They did not increase it, neither did they go lower. So that pause kind of indicates to the market that the CBK is giving the market, is giving the economy a little bit of time for those policy actions to flow through the economy. Now, if you look at the money market rates, if you look at some of the rates that depositors are getting, you begin to see that they are trending downwards. Inflation expectations, as you talk to people, anecdotal evidence, you begin to see that there's expectation that rates will come down. And even on the agricultural front, people expect a little bit of a better harvest. So when you take all those factors and look at it all at once, you kind of begin to see that you expect inflation to come down. And if it comes down, then you would expect interest rates to come down. Now, the pace and speed at which they will come down, it's anyone's guess, but directionally, the market expects the rates to come down.
Of course, all of this, Edwin, hinges on the global macroeconomic environment and what plays out within that scenario. With that being the case, just how much of a reliance is there on local consumption improving and that domestic demand starting to pick up a little bit more so?
Yeah, definitely local consumption, and the good thing about this region and sub-Saharan region in general, there's a growing middle class. So definitely local consumption picks up. The global piece that affects us, one, of course, the Eurozone, the Eurozone crisis. If you look at correlation between, let's say, the NSC and the Eurozone, there's a strong correlation between our own financial markets and the global market. So we are not immune from that. But fundamentally, this is a region where supply is the constraint. We can use more of everything, whether it's roads, healthcare, you name it. Supply is a constraint. The underlying demand and the growth of the middle class will support the economy.
So how do you see that major issue being dealt with, where supply is the constraint?
There's no silver bullet. I mean, if you look at our own country, there's heavy investment in infrastructure, so opening of the road networks. There's heavy investment in education. There's what I would call the reform agenda. You look at where we are headed politically, the business environment and the economic environment, and even in terms of governance, things are trended upwards. So if you take heavy investment in infrastructure, investment in education, improving political and governance environment, all those things over time, you are likely to see a lot of private sector financing coming in, and that should help with relieving a lot of the supply constraints.
Within what kind of political environment, Edwin? Because that is one of the factors that's said to possibly influence growth within this economy, especially with the ICC process. And then, of course, we've got the entire preparation for the upcoming elections that are underway as well.
Yeah, when I say the political environment, it's no one particular thing. It's pretty much looking at everything in totality. So let me break it down with a couple of examples. You look at the judiciary. The Kenyan public has a lot more confidence in the judiciary today than it had even a year ago. You look at the parliament. There's a sense that it's a more independent legislature than it used to be 2-3 years ago. You look at the election, the election process. The Kenyan public has more confidence in the electoral commission than it had before. So when you look at all these things, governance-wise and politically, it's headed in the right direction. Now, the pace might not be as fast as the investing public would expect, but at least directionally, Kenya is headed in the right direction in terms of governance and reforms.
What's your forecast in terms of the direction in which the NSE and the markets on the equities space is headed from here on out? Because we've still got a lot of bias towards more defensive stocks, despite this optimism that you've brought to the table today, and investors less exposed to those companies that are influenced by cyclical factors like inflation, like currency fluctuations, like interest rates and politics as well.
Okay. For 2012, I'll give you what I would consider the near-term view and then the longer-term view. For 2012, we view the stock markets as going to be, sideways for a couple of reasons. As I said at the beginning, we view this as a transition year. We are transitioning in terms of decreasing interest rate environment. We expect decreasing inflation, and also we are transitioning politically. So our stock market is predominantly driven by international investors. At any particular day, 60, 65, 70% of investors are international investors. So of course they are going to be a little reserved until there's a little bit of visibility, or at least certainty, in terms of the political process. And also interest rates are still high, so an investor could still lock in pretty attractive rates. If you combine those together, the international investor being a little bit reserved about the equity markets, the rates still being attractive from a fixed income perspective, you expect the equities market to be just moving sideways for most of 2012. Now, however, at the end of 2012, or the second half, depending on how people feel comfortable, if the transition will be smooth, you could begin to see quite a bit of activity in the stock market.
Well, let's leave it there.
That's the short-term.
Sorry, unfortunately, Edwin, we've run out of time. The clock is ticking, so we're going to have to leave the conversation there, but certainly something that we will be chatting to you about later in terms of the kind of progress we're seeing in that economy and the markets as well. Edwin Dande is CEO of British American Asset Managers.